Are you wondering how crypto taxes work in Australia, how to report your crypto to the ATO, and how much tax you'll pay on your crypto in Australia? In this updated video, I'm going to show you exactly how to do your Australian crypto taxes from scratch. Hi, I'm Nelly from Koinly, and in 2021, I shot our first crypto tax guide for Australia, and we received tons of comments and feedback from you guys that was really helpful. But a few things have changed since then, and I really want to get an updated guide out to you guys today. Before we jump in, it's really important to note that tax rules are constantly changing. We do our best to keep up to date with the latest guidance. This video is general information only and is not tax advice. So please speak to a qualified professional if you are looking for tax advice. Okay, so to get us started, I'm going to dive right in with a speed round of the basics. Afterwards, I will cover the most important stuff in more detail, and I will include a bonus round of trickier topics at the end. Okay, here it goes. Is crypto taxed in Australia? Absolutely. Crypto is taxable whether you are trading crypto as an investment or running a business. This means crypto is taxed under capital gains tax or accessible income, whether it's Bitcoin, altcoins, tokens, stablecoins, NFTs, airdrops, staking, DeFi lending, and more. How do you report your crypto to the ATO? You can report crypto the same way as regular income and capital gains in your annual income tax return. You can access this online using myTax through the ATO website and report capital gains and losses and accessible income. How much tax do you pay on crypto? It depends on whether you are an investor or running a business. In Australia, there isn't a separate capital gains tax rate for investors, so the amount you pay depends on the marginal income tax rate. There are other factors which may also affect how much tax you pay. For example, there is a sweet 50% tax cut on your capital gains if you've held a specific crypto for more than a year. Are individual investors and crypto businesses taxed differently? Yup, the ATO has different rules for individuals and traders running a business. However, it's worth speaking to a professional if you think you're running a business to ensure you are compliant and to make use of the tax reliefs available to businesses. If you made a loss on your crypto portfolio, can you claim a tax loss? Generally, yes. You can offset capital losses from your crypto against capital gains you may have made elsewhere. If you have no gains, individuals can also carry losses forward into future years. Can you claim a tax loss if you get scammed or lose your keys? If you lose your private key or your crypto is stolen by a hacker or scammer, you may be able to claim a capital loss. But it's a tricky one. You'll need plenty of evidence to demonstrate that the crypto is genuinely lost and irrecoverable. Okay, so with that out of the way, let's dive in a little deeper on how the tax system works for crypto in Australia. Individual or trader? I mentioned earlier that the ATO will tax individuals and businesses differently. For the most part, the people Koinly speaks to are typical investors. Basically, it comes down to this. Individuals are subject to the capital gains tax rules, whereas traders must follow the trading stock rules, where gains are recorded as business income rather than capital gains, and allowable expenses may be deducted for tax purposes, like, for example, mining equipment. If you're in doubt, we cover this question in a lot more depth in our guide, so I'll leave a link below to that section. It also might be worth speaking to a professional tax accountant to assist, as the boundaries between trader and investors can sometimes be murky. But for the rest of this video, I'm going to be addressing crypto investors specifically. How is crypto taxed in Australia? Okay, this one is pretty simple, as there are generally two ways individuals can be taxed on crypto, and that is income tax and capital gains tax. I'll start with capital gains tax. This is the kind of tax that people deal with when they sell a capital asset like shares or gold or an investment property. So it's the tax that less of us are familiar with. This may sound confusing, but there is no separate capital gains tax rate in Australia, and the capital gains are taxed at the same rate as your income tax. There are certain benefits that you can get through capital gains, such as if you hold your crypto for more than a year before selling or trading it, you may be entitled to a 50% CGT discount. Capital gains tax kicks in when you make a gain from disposing of your crypto. In other words, when you trade, sell, spend, or gift your crypto asset. To calculate your capital gain, you need to know the cost basis of your crypto. In simple terms, your cost basis is generally whatever it costs you in AUD to acquire your crypto plus any related fees, like trading fees. A capital gain or loss is the difference in value from when you acquired your crypto to when you sold or otherwise disposed of it. If you have a profit, you have a capital gain and you'll pay capital gains tax on that profit. If you have a loss from your crypto decreasing in value, then you have a capital loss and you won't pay tax. In fact, you can use that loss to your advantage, and we cover exactly how to do that in our Australia Tax Loss Harvesting Guide. The link is posted down below. Lost, stolen, or hacked. So here's the deal. If you happen to lose your private key or some hacker or scammer swipes your crypto, there might be a chance for you to claim a capital loss with the ATO. Basically, it boils down to whether your crypto is irrecoverable and you have the evidence to prove you owned it previously. If your private key is gone forever, then your capital loss claim is more likely to fly, so long as you have the right evidence. Same goes for those phishing scams where your crypto gets jacked and there's no way you're getting it back. In that case, you could have a shot at successfully claiming a capital loss in your tax return. Unfortunately, many exchanges like FTX and Celsius collapsed. While bankruptcy and other legal proceedings are happening, your crypto is not technically lost. It's just in limbo until bankruptcy proceedings play out, so typically, in cases like this, you won't be able to claim a capital loss immediately. Although, if you're still out of pocket after bankruptcy proceedings have come to a close, you may later be able to claim a capital loss. Like I said earlier, this topic is quite tricky, so we have a dedicated guide all about claiming stolen, lost, or hacked crypto, and I'll share that link down below. Right, so the next tax we need to look at is income tax. Just a heads up first, as an individual investor, traditionally you're about the long game, the capital gains. Of course, you can earn income from crypto in a number of ways, but it's easy to start acting like a trader when you're earning crypto income. So move with caution and get the right advice to make sure you are not inadvertently running a business. Okay, so what are the likely scenarios where crypto is treated as income? Here are 3 ways that make sense from the classic work perspective. Getting your salary paid in crypto. Selling NFTs you create, like an artist. Airdrops, excluding initial allocation airdrops. Becoming a validator and earning through a POS or POW. In these situations, you can earn crypto income and pay income tax. There are also other activities that may be taxed as income, including referral rewards like Binance Referral, learn to earn rewards like Coinbase Learn, browse to earn platforms like Brave, and play to earn games like Alien Worlds. Unfortunately, there isn't clear guidance on these advanced transaction types, so be sure to seek professional advice here. The conservative approach is to disclose these income type transactions in your ordinary income. And of course, DeFi has opened a world of opportunities to use your own crypto to earn more crypto, like earning interest through lending protocols like Compound or Aave, providing liquidity on decentralized exchanges like Uniswap, earning staking rewards from protocols like Lido. The ATO hasn't released guidance on DeFi tax yet, but that doesn't mean you won't pay tax on it. You could potentially be looking at income tax or capital gains tax for DeFi transactions depending on how your protocol works. If any of the crypto you've gained is viewed as income by the ATO, then you'll pay income tax according to your individual income tax rate. These rates can change a little each year, but you can get the latest income tax rate in our guide, and I'll leave a link down below. I'm going to come back to some of these scenarios like staking and airdrops, but first, reporting your crypto gains and income to the ATO is pretty straightforward, provided you use a crypto tax calculator like Koinly. That's because you need to report absolutely every transaction in a given tax year, and everything needs to be reported in Australian dollars, as valued on the day you acquired and disposed of your crypto. So that can be a seriously huge task and require insane record keeping. A tool like Koinly does this all for you and produces a report that you can then use to enter your capital gains, income, and other requirements straight into myTax, or you can give the report to your accountant. When to report your crypto tax. So the Australian tax year runs from the 1st of July to the 30th of the following year. If you are an individual logging your own tax return, you can do so between the 1st of July and the 31st of October of the same year. If you're lodging through an accountant, you may have until the 15th of May of the following year to file. Okay, so let's look at how you go about calculating your Aussie crypto taxes with Koinly. So to get started, you're going to sign up for a free account and then select your base country, Australia, and currency, AUD. Now, let's look at some important settings that you'll need to select, starting with your cost basis method. For individual investors in Australia, Koinly supports FIFO, LIFO, and HIFO, which are all allowed by the ATO. If you're a trader, you can only use FIFO. If you've selected your home country as Australia, Koinly will automatically select the correct tax year and time zone for you. Koinly will also automatically select the following calculation settings for you. The default settings for Aussie Koinly users are for investors, so if this is you, then you're good. Leave the settings as is. But if you're a trader who is running a business, then these settings may need to be changed. You have the option to toggle these settings to treat your profits differently, but if you're doing this, then you should follow specific advice from your accountant. One settings that investors may need to consider carefully is around airdrops, as initial allocation airdrops are not treated as ordinary income when received. The standard setting does not treat airdrops as income. If you have airdrops that are not initial allocation airdrops in your transactions, such as repeat airdrop of the same token, you'll need to find these transactions in Koinly and label the transaction as a reward or income. I'll come back to labels in a minute. Right, with your settings out of the way, it's time to connect Koinly to your wallets and exchanges so that Koinly can import all your transaction history. Koinly integrates with all the Australian exchanges and the international ones like Binance, Kraken, and so on. This integration happens automatically by Koinly connecting with supported exchanges via API, or you can upload transaction history as a CSV file if an automatic integration is not an option. We have hundreds of demo videos that show you exactly how to connect your blockchains and crypto platforms to Koinly. So if you're ever stuck, check out our video collection and I'll pop a link below. Now that Koinly has imported all your transactions, it automatically assigns a category to each trade. If I look at the transactions page, I can see all my trades and I can filter them out by transaction type. I can also select label to see exactly how Koinly has automatically categorized my transactions. I can see my forks and mining income, as well as staking and DeFi categories like liquidity in and out. It's important to review this as the labels will apply the relevant tax treatment, so you should double check that labels are correct and accurate. Where there are issues with input data, Koinly may flag this as an error. For example, if your purchase history is not visible. So if you see this yellow warning icon, it means Koinly has picked up an error with one of your wallets. These errors are usually easy to troubleshoot, so just follow the prompts until the warning icon turns off. With all the calculations completed, Koinly has summarized your position over on the reports page. This tells you a lot, but it's not enough information to file with. For that, we need a complete crypto tax report. Koinly offers a custom report for Australian investors that matches up with the ATO's required fields for crypto. So go ahead and select ATO report. If you haven't already subscribed for a paid plan, you'll do that here so that you can download your full tax history. Once you have your crypto tax report, you can either share it with your accountant via email or straight from your Koinly account. Or if you're confident that your situation is pretty clear-cut, then you might want to file using the ATO's myTax site. I've actually got a video that shows you exactly how to file your crypto taxes on myTax using a Koinly ATO report. So I'm going to leave a link to that down below. Okay, so that's the process there. And as you can see, it's all pretty straightforward. Now, as mentioned earlier, I'm going to take you guys through specific crypto scenarios to answer your burning questions on whether you'll pay tax or not. If your strategy is to simply buy and hold your crypto, then you don't need to pay taxes on the cryptocurrency if you hodl, even if the value of your portfolio increases. You only need to declare gains when there has been a capital gains tax event, such as when you sell, exchange, gift, or spend crypto. Whether you're buying crypto with crypto or selling crypto for crypto, it all works out the same from a tax perspective. Either way, in the ATO's view, you're making a disposal of an asset and therefore tax is due on any capital gain as a result of the transaction. Selling crypto for fiat currency like Australian dollars is a taxable event. If you have a gain, you'll pay a capital gains tax, either at your full income tax for short-term gains or with a 50% discount for long-term gains. Moving crypto between different wallets that you own is not a taxable event, but transfer fees paid in crypto may be a disposal, since the exchange may sell a portion of your crypto to pay the fees. It's also important you keep track of these movements to track the cost basis of your crypto, which Koinly can help you with. So just to make this clear, transfer fees paid in crypto that result in a gain will trigger a capital gains tax, similar to tax on spending crypto. This can be a small amount, but there are no exceptions for small transaction values, and every dollar must be accounted for in your tax return. The ATO hasn't released any official guidance on this just yet, but if you're adding or removing liquidity from various DeFi protocols, the ATO is likely to view each transaction as a disposal, meaning any gain may be taxable. As there's no official guidance, it's a good idea to get a crypto accountant to help out with DeFi transactions. You can find the link for Koinly's Australian crypto accountant directory in the description below. The ATO updated their guidance in 2022 to state that the initial allocation airdrops are no longer taxable when received. This is where you are airdrop tokens, which are the first of its kind, such as APE or ENS. For initial allocation airdrops, they are not taxed as ordinary income when received, but you will have to report any capital gains when you sell later. The cost base of airdrop tokens will be 0. For airdrops that are not initial allocations, they are taxed as ordinary income at market value when received. So you'll pay income tax based on the fair market value of your tokens in AUD at the point you receive them. For individual investors, you won't pay tax on coins if you receive a hard fork, but the cost basis of your coins is 0, which means if you later dispose of them, you will pay a capital gains tax. Because the cost basis for new coins from a hard fork is 0, you'll pay capital gains tax on the total value of your coin. However, if you hodl for a year, you'll still enjoy the 50% capital gains tax discount. When a coin or token changes blockchains, for example, when EOS left the Ethereum blockchain for the EOS mainnet, there are no tax liabilities. You can tag these transactions with a swap label in Koinly. Whether your reason for gifting your crypto is altruistic or opportunistic, the ATA cares not, and you will need to calculate capital gains tax on any profits from the disposal. If someone gives you crypto as a gift, consider yourself lucky for 2 reasons. You've just scored some crypto, and you don't pay any tax when it's received. But you will need to keep a record of the fair market value of the crypto on the day you received it, as this will become your cost basis. The bad news is back. While the receiving of a crypto gift is tax-free, any profit from a disposal, be it by selling, swapping, spending, or re-gifting, is taxed as a capital gain. In Australia, crypto donations work the same as regular donations. They're tax deductible. If you're donating to a registered deductible gift recipient, you can claim the donated amount as a deduction on your tax return, and any associated capital gain is exempted. A hobby miner is someone who participates in cryptocurrency mining as an interest or pastime, and not in a business-like manner seeking profits. For hobby miners, mining rewards are seen as capital acquisition, so they're tax-free on receipt, but you'll pay capital gains tax on disposal, and no expense deductions are allowed. The ATO says that a person conducting their mining in a large-scale business operation is a commercial miner, and most likely running a business. If this is the case, the tax treatment will follow the trading stock rules. Any proceeds you receive from a mining pool or service, or your own mining rig, are to be included as income. The mining equipment and associated costs may be deductible in your tax return. The ATO views crypto staking rewards as ordinary income at the point you receive them. This means you'll pay income tax based on the fair market value of your coins or tokens in AUD. If you sell later or otherwise dispose of your staking rewards, you still need to pay capital gains tax on any gain, just like you would if you disposed of any other crypto. Use the fair market value you calculated when you received your crypto as your cost basis to calculate your gains and losses. The ATO hasn't released any guidance on crypto margin trading, future trading, or other CFDs just yet. So if you've made these kinds of transactions, you should absolutely speak to a crypto accountant for advice. That said, it's likely profits from margin trades or futures would be subject to income tax at the point you close your position. Are you a NFT creator? Awesome. Now, the tax implications of creating and selling NFTs will all depend on whether you're seen as partaking in a hobby, acting as an individual investor, or running a business. If it's a business, this is akin to creating and selling any other product and therefore qualifies as business income, which will be subject to income tax. Okay, so if you're trading NFTs, generally whether you're selling, swapping, or gifting NFTs, you'll pay capital gains tax on most NFT transactions. That is, if you're not deemed to be a trader or conducting business activity, in which case business tax rules apply. What about buying an NFT? If you're paying with crypto, which is usually the case, this is also a taxable transaction. You'll be up for capital gains tax because you've spent crypto to buy the NFT, unless the purchase qualifies as a personal use asset, and we'll cover that at the end. Participating in an ICO may amount to crypto trade. The taxable event is triggered on the date of the ICO transactions when you receive the new tokens. If you sell the new tokens at a later date, the cost base of the transactions will be the value of the cryptocurrency that you paid for on the date of the ICO/IEO. It's worth noting there isn't clear guidance on this from the ATO. Okay, so if you're getting rewarded for signing up or referring users to a service, any crypto you get in return is taxed as income. Whether you're freelancing or working for a company that pays employers in crypto, any coins received as income are taxed at the market value at the time you receive them, and subject to the same employment income rules as if you were getting paid in fiat currency. Generally, spending crypto is a disposal and any gain is subject to capital gains tax. The only exemption is if your crypto is a personal use asset. There is a specific rule that means you may be able to spend crypto tax if it's considered a personal use asset. But personal use assets are capital gains tax exempt, so they may be handy. This is definitely higher grade stuff, and it's actually pretty unlikely that the average crypto investor will be able to use this rule. So I'm going to link to our guide in the link below on this one. So there you have it, an epic look at Australian crypto taxes and how you can file your taxes fast with Koinly. As always, check the resources down below. And that brings us to the end of this video. If you found it useful, consider dropping a like, subscribing for more content like this, and as always, if you have any questions, leave them down below and we'll be happy to help you out.